Good evening, everyone. Welcome to the channel. Today I am going to talk about National Beverage Corp. Quarterly Report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. And National Beverage Corp. Offers a diverse range of products and services through its subsidiaries. Some of the key businesses and services provided by the company include sparkling water production under the La Croix brand, non-carbonated water production under the Clear Fruit brand energy drink, and shots production under the Rip It brand juice, and juice-based product production under Everfresh. Everfresh Premier Varietals, and Mr. Pure brands carbonated soft drinks production under Shasta and Fago brands. The company serves various channels including retailers, take-home, convenience, food service, and smaller up and down the street accounts through its distribution network in the United States and Canada. The decline of National Beverage Corp. Fizz stock price over the past year can be attributed to a combination of factors. Analyst downgrades and underperform ratings from firms like Jefferies and UBS Group have contributed to negative sentiment, with UBS lowering its target price to $40 and assigning a sell rating. Additionally, missing Cone earnings and revenue estimates in September 2025 further exacerbated the decline, as the company reported lower than expected earnings per share and revenue despite setting a record for revenue. The CEO's comments attributing the drop in quarterly earnings to injustice rather than mismanagement or external factors have also raised concerns. The decrease in interest income due to lower invested cash balances following a significant dividend payment has also played a role. Overall, the stock's performance mirrors that of the broader U.S. beverage industry, which returned minus 11.8% over the past year, suggesting industry challenges may be contributing to Fizz's decline. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in average selling price per case has contributed significantly to revenue growth, with a notable 4.4% rise. Additionally, the development of healthier beverages in response to changing consumer buying habits has also driven revenue upwards. Furthermore, the introduction of unique flavors and varieties across brands has been instrumental in boosting sales. These factors have directly contributed to revenue growth, making them crucial components of the company's success. Net income and profit margins. A mixed trend. The financial summary reveals a mixed trend in net income and profit margins. Initially, net income increased, page 11, indicating a positive growth in earnings. However, this upward trend was short-lived as it decreased due to a decline in operating activities, page 13. On the other hand, profit margins likely experienced an increase due to higher average selling prices per case and lower costs of sales per case, page 12. Despite this, no specific percentage change is mentioned. The company's financial performance indicates a significant achievement in its ability to generate cash from its core operations. A key indicator of this success is the generation of positive operating cash flow, which suggests that the company is capable of producing sufficient funds to cover its operational expenses and invest in growth initiatives without relying on external financing. There is no clear indication that the company's debt level or interest expenses have changed significantly. The only relevant information provided is on page 13, which shows an increase in cash position and a decrease in capital expenditures, but this does not provide any insight into changes in debt levels or interest expenses. Management is optimistic about the company's outlook, citing its unique product designs, packaging, and flavors as key drivers of growth. They aim to achieve profitable growth by developing healthier beverages and responding to changing consumer trends. Additionally, they are confident in their ability to meet liquidity and capital requirements for the next 12 months with existing resources. There were no notable acquisitions or divestitures in this period, indicating a stable financial landscape with minimal changes to the company's assets and holdings. The company has made a significant payment to its shareholders in the form of a special cash dividend of $304.1 million, indicating a commitment to returning value to investors. However, there is no record of share buybacks, suggesting that the company's focus was on distributing excess funds directly to shareholders rather than repurchasing existing shares. Concerns about inventory buildup and supply chain disruption have been raised due to recent data indicating a significant increase in inventories, with a notable decrease in inventory turnover rates. Specifically, the company's inventory levels rose by $8.8 million, while its inventory turns decreased from 8.7 times to 8.2 times. These metrics suggest that the company may be experiencing difficulties in managing its supply chain effectively, potentially leading to stockpiling and inefficiencies. That concludes the financial summary. For National Beverage Corp, feel free to comment below, and I will be happy to answer them when possible.